Education bonds can be a very handy tool for families looking to save for future education costs, whether that's primary school, high school, or higher education. Offering tax advantages and flexibility, education bonds provide a structured way to grow funds in a tax effective and potentially no tax environment. In this video, we'll break down everything you need to know about education bonds so you can determine if they are the right fit for you. An education bond is similar to an investment bond, but with a twist. It's tailored towards education-related savings. You can think of it as a dedicated investment account with tax benefits. An education bond is a type of life insurance investment contract, meaning it comes with a few quirks that we will discuss in this video. The money contributed into an education bond gets invested in line with your chosen investment strategy. Depending on the bond provider, you'll have access to a range of different investment options, from conservative to aggressive. It's important you choose an investment strategy that suits your risk profile and investment time frame. The strategy you choose will determine the performance of the bond. Before committing to an education bond, you should check the investment options to ensure they align with your objectives. Some providers offer a broader range than others, giving you more flexibility. One of the primary reasons education bonds are utilised is the potential tax savings. Here's how the tax treatment works. 1. It's a tax-paid environment. Just like investment bonds, the earnings inside an education bond are taxed at a maximum rate of 30%, but the actual tax paid can be lower due to franking credits and offsets. The taxes are paid within the bond itself. You don't need to worry about including any of the earnings or capital gains in your personal tax return, making it very simple to manage. 2. There's a tax rebate for education. The big selling point of education bonds is that if the bond is used for education purposes, any tax that was paid within the bond itself is rebated. For example, for every $70 of earnings withdrawn for education purposes, an additional $30 tax rebate will be added to your account. The bond provider will apply for this rebate on your behalf. However, there may be personal tax implications applicable to the beneficiary of the bond upon withdrawal. We delve into this a little bit more soon. And 3, the tax-free withdrawals after 10 years. Even if you don't use the funds for education, after the 10-year mark, the earnings on the bond can be withdrawn tax-free, acting exactly like an investment bond. In this instance, however, you wouldn't get the tax rebate, as the withdrawal was not made for education purposes. There is a negative from a tax perspective that is applicable to education bonds and investment bonds alike, and that is that they don't receive the 50% general discount for capital gains tax purposes. You can access your education bond at any time for any purpose. However, the tax rebate only applies when the withdrawal is for education purposes. The capital component of the bond, that's the money you put in, will always be returned tax-free. Tax may be payable on the earnings component of the withdrawal, depending on the purpose of the withdrawal, who the beneficiary is, and how long the bond has been operating. It is important to consider that if the beneficiary is a child below the age of 18, the earnings component is taxed at the child's marginal tax rate, noting that the minor tax rates will apply unless they qualify for accepted income. Given this, it is generally advisable that you choose an investment bond provider which allows flexibility to choose where the withdrawal is funded from, that is, either the capital or the earnings. This allows you to limit your withdrawal from the earnings component to $416 for a minor, as this is the current tax-free threshold, taking the remainder of the funds required from the capital component, which is not accessible. Where withdrawals are made for eligible education expenses, the tax rebate will be added to the earnings component of the bond. This will occur regardless of the beneficiary's age and how long the bond has been held for. Here is a summary of the tax implications of withdrawals depending on the type of withdrawal, the purpose of the withdrawal, and who is treated as the recipient of the money. One handy aspect of education bonds is that you can generally retrospectively claim education expenses. This means that you do not need to incur the education-related costs in the same year as the withdrawal. You can claim the education expenses from previous years post the establishment of the bond. This gives you the flexibility to withdraw the earnings component for previously incurred education expenses once the beneficiary is over the age of 18 and has access to the adult tax rates. Like investment bonds, education bonds follow the 125% contribution rule. This means that after the first year, you can contribute up to 125% of the previous year's contributions without restarting the 10-year tax-free clock. If you skip a year of contributions, you won't be able to contribute further without resetting the 10-year timeline. For instance, if you contribute $10,000 in the first year, you can put in $12,500 in year 2 and so on. If you don't contribute in year 2, you'll either have to start the new bond or reset your 10-year period. If your plan is to use the education bond for education purposes, then the 10-year rule doesn't matter too much in this instance. Education bonds can also be a powerful estate planning tool. You can name the beneficiary, bypass the will, and ensure the funds go directly to the intended recipient, whether it's for education purposes or otherwise. This is particularly useful if you have complex family dynamics or want to avoid the time-consuming probate process. Moreover, if the life insured passes away, the bond can be paid out to the nominated beneficiary without triggering any tax consequences. Even if the bond hasn't reached the 10-year mark, this can be a valuable strategy for intergenerational wealth transfer. Each bond provider has their own set of fees, which you need to consider before commencement. This typically comprises of an administration fee and a management expense ratio applicable to the chosen investment option. One common criticism of education bonds is that they add an extra layer of costs, which could be avoided without utilising the bond structure. However, unless your assessable income is below the tax-free threshold and you can't see it changing in the future, then the tax benefits associated with the bond often outweigh the additional costs. Here at Guide Investor, we like education bonds. In the right situation, they offer not only tax minimisation, but also bring discipline to your education savings through the use of a regular investment plan. Being a tax-paid structure, it's also super simple to manage once it's established. However, a lot of care needs to be taken to determine when the best time to access the funds are, taking into account the minor tax rates. We would typically only recommend an education bond be established in phase 2 and up of the wealth creation process. If you do not yet have a strong financial foundation, then you're not ready to invest for future education purposes. You need all the cash flow available to establish your financial foundation first. If you think an education bond is an appropriate strategy for you, we strongly recommend you speak with your financial advisor. They can help assess the appropriateness for your particular situation. Please note, the information contained in this video is general in nature only and does not take into consideration your objectives, financial situation, or needs. As legislation is constantly changing, the accuracy of this information is only current as at the time of recording. Before relying on the information, you should check to see if the content is still relevant.